Good afternoon, everyone. Thank you very much for coming. Welcome to the first Capital Markets Day of the newly renamed Seplat Energy Plc. Want to welcome you all in person, on the phone lines and on the webcast. Thank you very much for coming. I'm especially grateful that people have actually turned up in person. I'm kind of expecting that hoping or dreading that this will turn out like that scene towards the end of The Big Short where everyone's phones start going ping, ping, ping. We've already had one of the team got pinged yesterday, but luckily she tested negative today and is able to be here. But that's great. But thank you very much. Perhaps this is a return to in-person investor relations, which is great. Soon be racking up the air miles, I think, for the road shows and everything. But thank you for joining us. As you'll have seen, we released results for the first 6 months of 2021 this morning. You'll have also seen that we announced we're being joined by a new director, Emma Fitzgerald. I'm delighted to say that Emma's in the audience today. She's joining us as an independent non-executive director. I'm also delighted to say that we're joined by Professor Ajogu and Mr. Rabiu, who've also joined recently as directors. I want to welcome you all to the company as we go into the next phase of our existence. On the platform today for today's presentation, you'll recognise our regular team: Roger Brown, Chief Executive; Emeka Onwuka, Chief Financial Officer; Engineer Effiong Okon, Operations Director; and Yetunde Taiwo, Director of New Energy. We'll be doing the presentation in two parts with a short break halfway through just to top up with water. And at the end of the presentation, we'll open it up to questions first from the floor and then from the online world. So if you could hold the questions till the very end, that would be great. So to open today's presentation, we have a welcome video from the Chief Executive of the Nigerian Exchange, Temi Popoola. Perhaps if you could roll that, please.
Good afternoon, distinguished ladies and gentlemen. It gives me great pleasure to welcome you all to today's Capital Market Day celebration. This event is particularly dear to me as it comes at an interesting and pivotal time in the history of the Nigerian Exchange Limited, as we just concluded our demutualization in Q1 2021, joining the ranks of demutualized exchanges in the world. Today marks another significant milestone for Seplat Petroleum Development Company plc, as it changes its name to Seplat Energy Plc. This is reflective of the vision that it has to provide an update in their corporate strategy and the efforts by the organization towards transitioning into a full energy solutions company, with the goal of being a key player in promoting and operationalizing a lower carbon fuels and renewables economy. Over the last decade, Seplat Energy Plc has remained the leading Nigerian independent energy company by becoming the first energy company to be dual listed on both the premium board of the Nigerian Exchange Limited and the main market of the London Stock Exchange. This dual listing was facilitated by the working arrangement between the LSE and the NGX. This arrangement enables seamless cross-border capital formation between Nigeria and London, ultimately driving deeper our markets and market capitalization for Nigerian businesses. Since raising Tier 1 capital via the IPO of $535 million in 2014, the company has returned $344 million as at the end of 2020 in dividends to investors, and it has returned a 15% share price appreciation on the Nigerian bourse over the last 3 years, and it continues to grow value to shareholders. Seplat Energy plc's commitment to sustainability and its strict compliance with corporate governance policies and code of business conduct is exemplary. Therefore, as Seplat continues to drive forward its strategy of being a low-cost energy provider, delivering reliable, affordable, and sustainable energy to the young, fast-growing population of Nigeria, the NGX strongly commends this drive as it will significantly impact environmental, economic, and social benefits that support the United Nations Sustainable Development Goals. The NGX will continue to support and encourage the activities of Seplat in achieving its strategic initiatives. Finally, on behalf of the board and management of the Nigerian Exchange Limited, I commend the management team of Seplat Energy Plc for a successful Capital Market Day event, and I thank you and the distinguished audience who has traveled to grace this event in person and online.
Thanks very much. I'd now like to welcome Chief Executive Roger Brown to the stage.
Thank you, and good afternoon, everyone. I hope everyone's well, and it really is great to see people in person. It's very helpful. Okay, so I'm going to kick off, run through the first section here, which is really setting the scene for us. And then what we'll then do is we'll go through, Emeka will speak, I think next, then Effie will take us through, and Emeka will cover all the sort of financial aspects, commercial aspects of the business. And then we'll get into Effie, and Effie will cover all the operational aspects. And then finally with Utundi, who will cover the midstream gas and also the new energy side of the business. So am I controlling this? I think I am. Okay, so Seplat Energy, obviously operates in Nigeria. And when you look at Nigeria and you look at the opportunity set within Nigeria, it is enormous. This is Africa's largest population. It's got 200 million people, slightly over that today. It's rapidly growing. I think the average female has 6 children, and it's the 7th largest country in the world. And within the next 30 years, it's going to be the 3rd largest country in the world, with somewhere between 400 and 450 million people. So the population is going to double in the next 30 years. It's actually the 2nd largest democracy it will be. So it's a very material country that needs a lot of infrastructure, and we'll run you through some of the opportunities. Interesting fact there, more children are born every day in Nigeria than children born in the whole of Europe. I think it's every 10 years, the population size of the UK will be added in Nigeria. So it is very rapidly growing. If you then look at its resources, it has abundant energy resources. It's got 37 billion barrels of liquids, which currently is estimated to last the next 40 years without any additions. An average day production is 1.6 million barrels a day for 2021. It's been above that in the past. But Nigeria it's known for an oil province, not an oil province, it's actually a gas province. There's more gas in Nigeria than there is in oil. So there's 203 TCF of gas reserves at the minute. It's actually estimated to probably be 3 times that. Its current production of gas is only 8 BCF a day. And about half of that is exported through LNG. Some part is reinjected and some part's flared. And so a fraction of that, probably an eighth, is actually utilised within the country. So there's huge potential there. And if we took all the flared gas and put it into energy, it would give us 5,000 megawatts or 5 gigawatts. Our reinjected gas would be 15 gigawatts. So it's a huge amount of gas reinjected. Solar is under electrified from the solar perspective. And then you can see their potential in the hydro is 14 gigawatts. So it's huge renewable potential in country. Sorry, I should probably cover off just some of the GDP. It's estimated at more 600 billion. It's the highest GDP in Africa. And it's 22nd in GDP, but it's projected to be top 10 globally by 2050. So it's huge urbanization and efficiency, but it needs a huge amount of infrastructure. If you then look at 2020 versus 2040, a lot of this source of information is from Wood Mackenzie. We commissioned a study, And you can see there the projected growth of GDP, population. So you can see growth in every aspect of there. Today, just slightly more than half of the population of Nigeria has access to energy. What we mean by that is it has access to electricity. The predominant energy source in country is biomass. So it's cutting down trees for wood for cooking. That's about 80% of the energy use in country. Of electricity then we're talking about slightly more than half have got access to that energy. And the capacity is about 26 gigawatts. That's forecast to grow on the chart there. If you add all those boxes on the right-hand side, it gets up to about 73 gigawatts. So there's a trebling of demand over the next 20 years, and we think that's understated. I think it's much more than that. If you look at the generating capacity, 20 to 25 is diesel generation. So that's importing diesel into very small scale generators, which are hugely inefficient, high in CO2, and lots of noise abatement and everything else. So what I'm trying to say here is a huge potential of actually changing the transition of the mix of energy in country and actually saving a lot of money. And we've got some slides to deal with this as we go through the slide deck. What are the impediments? So as per the Woodmac study, the estimated cost of that diesel is 52 cents a kilowatt hour. It's one of the most expensive, if not the most expensive power in the world. The average on-grid cost of electricity globally is about 14 cents a kilowatt hour. So it's more than 3 to 4 times that. And it's this diesel generation that needs to be displaced and dealt with. Low access to energy we've talked about, lack of grid infrastructure, especially in rural areas. And despite the 12, almost 13 gigawatts of installed capacity, only a third of that reaches customers. 80%, as we said earlier on, is used for biomass. So deforestation, by displacing that wood for cooking, we then avoid deforestation. That's a huge potential. Energy access will drive Nigeria's development. What does that mean? It's energy for employment, energy for food, energy for healthcare, education. Without energy access, Nigeria is not going to develop to the level it needs to. So what about our story? So where does Seplat sit within this story? Well, if you look at our production since 2012, we have all the charts every year. You can see there we have a growth rate. And if you take out 2016 and 2017, where we had pipeline shut-ins, and that's why those numbers are lower, you can then see a good projection of growth in both gas and oil. If you look in 2012, you can see our gas growth is quite substantial. So we made a decision 8-9 years ago that we saw gas as being a big growth area for the business, and it's come true. So a lot of our volume now, about half and half, but not quite, but it's probably more like 2/3, 1/3 gas oil against gas. And we have projections, we have confidence in our portfolio that we can grow this well into the future. So it's 4 times increase in gas production and increased total production by nearly 31,000 oil equivalent per day. We've also built a strong financial profile. We listed in 2014, we raised $535 million. We dual listed, the only company that's ever done it, on the main board of the London Stock Exchange and also the Nigerian Stock Exchange. And now we are premium board listed there. We raised $535 million of equity at that point. And since then, we've returned over 400 million back to shareholders through dividends. So our dividend policy, and that's even if you adjusted for the downtime in 2016, 2017, real confidence that we probably would have returned all of that money back to investors. So the message here is, we're a dividend payer. We've always been a dividend payer from day one. and it's a good way for investors to get their return. We've invested 1.9 billion of capex since IPO, raised $2.5 billion of debt, and repaid $1.7 billion of debt. So our access to capital is proven, and we have quite a diverse range of banks and bonds. But Mecca will get through it in his section. And then the world-class board and governance. So we started off from day one with a governance drive, really to set a board together. It's a big board, and it's big on purpose because it needs to satisfy two codes of the Nigerian code and the UK code. And you can see there we've obviously got the executive chairman, the executive management who are here today, non-exec directors. So the Olivier at the right there is Molan Prom, and Natty Dillapam was at Molan Prom, and now she's on our board. And then we have independent non-exec directors, but not all of them because Dr. Emma Fitzgerald is not on that. She just announced today. But we have Aroma Otey. She was the head of SEC when we first listed. Basil Omi, Charles Okehalam, Professor Fabian Jogu, Bella Rabu, who are both in the audience here. Very experienced individuals from their expertise. And then Xavier Rowley, who was the ex-chief exec of the London Stock Exchange. Then we look at the leadership. So we have our senior leadership team. Quite a number of them are represented in the room here. You've got three at the table there. Technical Director Gary Thompson, and then you can see the managing directors here are the runner assets. So we have our Western assets, our Eastern assets, gas assets, and Elcrest. And then we have obviously the other directors which are represented in the room here today. So we have, we have everyone represented in the senior leadership team. We meet monthly. We have asset management meetings every week anyway. So I won't go into too much detail of that, but we've compiled a very strong balance of skill sets here. And then going to some of our real stakeholders, what have we contributed back in doing this? We're paying dividends. We're also to Nigeria since 2010. We have contributed 6.2 billion to revenue for Nigeria in our operation, 1.1 billion of royalties, taxes of almost 300 million, and NDDC and NCD, these are the local content development bodies, and we've put just slightly over $150 million. To communities, we are very much in healthcare and education. We've got 3 million into the communities, in education, 2.4 in healthcare, and obviously with COVID-19 with relief packages. And then Nigerians, local contractors, we have very big representation from the local content contractors, and that's critical. That's very important for freedom to operate in country. Is to actually employ Nigerians in our operations has been one of the mainstays of why we've been successful. Let's look at, we put it here, I won't go through every single one of them, but just our sustainable development goals. The reason why we put this up is because there's obviously a lot of focus on ESG, and that's very much part of where we're addressing the part of it. But for us, it's slightly different because a lot of the ESG statements are E-driven statements. And of course we have those, we'll run through what our plans around that from the environment. But as importantly, if not more importantly, is the social development of our business. And we've been very active socially for the last 10, 11 years. We probably haven't talked about it enough, but we'll start to set those out in our plans and our targets. And what we've done here is just giving you how we're addressing each of the sustainable development goals from the UN. Will it be good health, well-being, employment, etc. That's the mainstay of what we're doing. Social impacts, we have our programs and healthcare programs. I can see is a sort of a surgery, looking at cataracts mostly, etc. We've had eye surgeries, reading glasses, eye disease treatments, safe motherhood programs, COVID relief packages, and then education. So these are the three sort of main areas. Education, scholarships. We have a scholarship program. We have a fantastic Pearls quiz, which we've seen 45,000 students through, and we have a teachers program. And then empowerment is one area that really we see multiplication from, which is the empowerment of entrepreneurs. So what Nigeria needs to do a lot more of is create these ecosystems from more and more businesses, and that will need energy. So we need energy to be able to do that. We have an empowerment program, skills acquisition, and vendor capacity development. And this is in the areas when you get wealth and prosperity in the areas that we operate, then we actually find that it's a much more peaceful place to work. Safety. Essential safety. We have a safety culture. If we look at the man hours, and this is just specifically from our Western assets at the end of June this year, we had 20.5 million man hours without a fatality or a lost time incident, LTI. So safety is really at the heart of what we're trying to achieve as a company. I'm sure Effie will get into that in a bit more in his section. And then going back to our inorganic activity, we're the first Nigerian acquisition of a UK listed company when we bought Eland Oil and Gas at the end of 2019. We're well into embedding that into our business, and we're actually drilling quite a number of wells there this year in exploration. So again, we'll get into that. But there's a superior exploration potential there, which I think is a real big value uplift. So, Seplat Energy. So why change the name? What's it all about? And really, this is looking at the future of our business. We have designed our strategy is really about the transition journey within the country. If you look on the Venn diagram at the far right there, we're making a clear statement here that oil does remain crucial for Nigerians' development. To simply leave it in the ground is not going to develop the country at all. So we need to make sure that we're efficient in the conversion of that oil into dollars, and then we're efficient in how we reinvest those dollars. On the far right there is gas will drive the transition, and Nigeria is a gas province. That gas will then enable two things. One is moving off diesel-generated power today, and at the same time is actually allowing that platform for renewable energy, which you can't really get big-scale renewable energy on grid without a base load. We've got it in the UK. Without a base load power, we need that base load. That base load, in our view, is gas. And then renewables is just part of the energy mix. It's really the future, and we've got some slides. Tunde will run through that in some detail, but actually we look at, it's predominantly solar that we're looking at. Nigeria's energy transition journey. So first of all, there's 5 points there. First point is energy access. It's critical. With social, you're not going to get social development without energy access. It is a ridiculously low level of energy access in country today for a population this size. Second one is what we call a just transition. Transition has many definitions. And what we're saying is we want our transition to be right for Nigeria to address a number of the A and the S elements. So we want to use Nigeria's gas resources to displace this expensive electricity. And again, you'll show you a slide on that of what we think it costs annually, but it's a frighteningly high number. We want to increase the renewables, abundant sunlight, 6, maybe 8 hours a day, every day, the sun. Reduce greenhouse gas emissions and meet the 2050 Paris objectives, and Nigeria is a signatory to that. And obviously avoid the fifth one there, which is this firewood deforestation. We want to avoid that by developing LPG into cooking. Our energy transition priorities, 5 here. We want long-term growth, by the optimal energy mix. That's critical, optimal. Be the national energy champion. We've been very successful the first 10 years. We want the next 10 years to have even more success. We want to be the partner of choice for the government and anyone coming into Nigeria and really driving that transition. Where social and economic development through our operations, where we operate a number of our programs. Lower carbon world will require different products and skills. Nigeria's skill set is very, as you'd expect, hydrocarbon driven, and we need to look at new skills going through for new technologies. And then significant reductions in corporate emissions. And again, we will replace diesel generators in our operations with solar as we bring down our scope 1 emissions. Okay, so strategic framework. I won't go into too much detail around this, but basically overpinning this framework is one is strong governance. We have value, integrity, and partnership, very critical at the bottom, and then safety. So they frame our strategic framework. Then we come out with a strategy, and on the left-hand side is sustainable business on 3 pillars, which is social development, environmental care, and financial returns, and that being quite critical, and we've demonstrated all of those. And then transition, deliver that transition upstream by actually reducing carbon emissions in our operations, get more efficiency in the upstream. Midstream gas, we'll talk a bit more about this, but build that out. And then define what new energy means for us, and then start to access new energy opportunities for increasing access to energy. So sustainable business, key priorities, we've got 3 here, which is obviously the social development. We've got to make a positive impact to the communities. I think for the last 60 years, the communities have seen oil extraction, and you know, we need to put more investment into those communities so they start to see real benefits from that. Access to energy, local employment, suppliers, you know, these communities are growing rapidly, and we need to be able to give them some jobs, etc. And key initiatives there is community employment, local entrepreneurship, and this is really building ecosystems. So creating business parks, industrial zones where businesses can operate, entrepreneurs can function. It's very difficult to function when you haven't got energy, you haven't got power, you can't put the light on, you can't get the air conditioning. It's really difficult, and it really is holding back Nigeria. There's a high intelligence level and education, but without reliable, affordable energy, you're not going to really develop it. So that's where we see ourselves providing that energy in the long term. Access to energy in local communities. Focus on environmental, second pillar, environmental care and reporting. And again, this is be coming out with ESG targets. We'll report them in our 2021 annual report, so you'll see those in Q1 next year. So there'll be scope 1 and 2 carbon emissions, and we're looking at scope 3 at the minute and see what we want to report around that. And then whatever framework that it looks like TCFD is the sensible one for us to follow. But actually reporting, we're doing data gathering at the minute, but reporting and setting those targets, and then maximize returns for all stakeholders. And that really is a fair split of the business in terms of our achievements across, will it be communities, will it be government, will it be employees, or today obviously investors to support us. So and to be the partner of choice. I think we have a very unique opportunity here, being an indigenous company, well run, very high level of governance, to really be that kind of home for investment, where investors can come in and trust that investment will make a return and will be well looked after. And so looking at inward investment from all around the world in to allow Nigerians to develop these skills. And then deliver transition. So again, we'll run through this a bit more, but in our upstream business, this is the key initiatives. I'll focus on those. Got to monetize the reserves. We've got to be lowest quartile in the global extraction of oil. We've got to look at export routes are reliable, so we don't get downtime and losses. Bringing in some technology. I think the technology into Nigeria hasn't been as advanced as it has been in other parts of the world, in US, UK, etc. There's a lot of technology we can bring in, smart well techniques, and I think we can really drive down the cost of our operations. Decarbonising all our field operations. Flares Out programme, and Effie will run through that in his section. And clearly, setting realistic timelines for project delivery and delivering on them. On the midstream side, to date, we took a view in 2012 to invest in it. It's been a highly successful, probably the second biggest gas processor in country. And when ANO comes on stream, middle of next year, we will be the biggest gas processor in country, actually next to government. And really this gas value chain and growth is really going to be the very key transition tool. So looking at that is looking at higher utilisation of our gas plants, deliver ANO, which is the new gas plant in the east, develop new gas markets, and really that's looking at going down the value chain a bit. We're selling bulk. We actually should be looking to sell smaller parcel sizes for higher gas prices. LPG for cooking. And CNG, it's a huge, we're CNG for automobiles, but also CNG for other usage. It's pretty easy to put a compressor on our gas plant and capture that CNG. And then new energy is really moving down that value chain. So we call it going from molecule into electron, going into gas to power. And then electricity really being that bridge of where Nigeria goes into renewable energy. So solar by itself has a cyclical nature to it. It's 6 or 8 hours a day. So you really need a combination. When you're looking at renewable energy, you need a combination of baseload. And gas is an excellent baseload. Battery technology will as well. So that new energy business we'll talk you through in a second. Okay, so I don't know how we're doing for time, but Carl says we're on track. So social development, driving that. These aren't just words on a piece of paper. This is something we've done for 10, 11 years. Don't think we've talked about it enough, and we need to talk more about it. So it's this positive impact on communities. Local employment, we have a rule that provided they have the capability to do it, we will use local contractors. We have capacity building days where we train. We have workshops. So we have a rule within the business. Let's start to generate a lot of employment in our areas. And we have the cases of you get the start where the contractor is doing catering in the first year, and by year 5 he's built you a pipeline. And it's that sort of generation of employment which has been hugely lacking in Nigeria, because I think all of the assets were tightly held by a couple of companies, and I don't think it was as wide as it could be in terms of growth of jobs, etc. So here's our partnership with the community. We have this thing called a Global Memorandum of Understanding. It sets out the rules of how we engage. It has, of course, CSR embedded in it, but it's much more than that. It's actually employing them. It's treating them as partners. It's what we call freedom to operate. It's not a group of people that we contain. It's actually people that we bring into our operations, and then they help us grow our business. And so we have these every 5 years. We renegotiate them, and they cover, I guess, looking at it beyond the employments, cover sort of 4 areas there, and you can see you've got social investment. And again, this is aligning with the SDGs. Also, the African Union 2063 we're aligning with in terms of health, education, economic procurement, environmental care. education. I won't go into too much because I've already covered a lot of this thing. Local employment, again, I've majored on that, but on purpose. It's very critical. Local entrepreneurs is really helping and kind of shaping the direction of skill sets. And then statutory interventions agencies funding, whether we do the Niger Delta Development Commission, the NCD levy, which is then does a lot of local content, or tertiary education tax, and we have a number of teacher programs. So this is live. It's been here from day one. We give you the stats of what we've spent in the communities, and we will continue if we get a new acquisition, new asset onshore, even shallow water offshore or anywhere else. We come in with this GMOU, we negotiate, and we get to landing, and then at least the communities know what the rules are. And then looking at environmental care and reporting. So we have 2 ratings. We've got the MSCI rating and Sustainalytics risk rating. MSCI, you can see we've just been upgraded. So at the end of March this year, we went from BB to BBB. And then on Sustainalytics, again, we have a very clear rating there. We're 31 out of 171 in the E&P companies. And I think confidently, by having more measurement publicly and people can now start to see in their policies, etc., we're confident we can actually improve these ratings quite significantly as a business. Goal: minimise our impact on local and global environments, drive improvements where possible, commit to global standards, and transparently report our progress. We've been doing that since day one. We're the only dual-listed company. We're on main board, the only Nigerian company on main board London. And we're also premium board listed in Nigeria. Transparency is key to us. So in terms of the baseline in ESG, we have a team on board now. We're setting that baseline for the ESG performance. We're going to come out with targets, as we said in the 2021 annual report. And that's really going to be heavily focused on 1 and 2 emission reduction targets, etc. And then we'll report going forward. We're going to adopt integrated reporting, and we're going to embed this much more within the business. And I will be back before the end of the slide deck, but now I'm going to hand this across to Emeka. Thank you.
Good afternoon, and we've heard all the opportunities and the activities of Seplat in terms of mining the opportunity in oil and gas in the country. The next thing is that what does it mean in terms of return to our stakeholders? Our stakeholders go beyond just equity providers. We'll manage our finances in a manner that will focus mainly on prudent financial management. In order of priorities, we invest for the future. We pay our taxes. We also, apart from paying our taxes and royalties, service our debt, and then return dividend to shareholders. And Roger talked a bit about that in terms of how much we've returned that dividend since the IPO. As a company, we see ourselves as having a stewardship responsibility in terms of managing the natural resources of Nigeria. And the discipline we bring to this has seen successful operations over the years, even in very difficult times. Roger talked about the fact the company took a bet on gas over the years. And that bet that we've taken on gas had led us to be a major processor of gas. Currently, doing have almost 30% of the gas supply to the generating companies in the country. And if you look at the level of production shown in the slide, upper part of the left side of that slide, you can see how our gas production has increased over the years. Roger talked about a third of that production today being gas and about 2/3 being oil. For other purposes as well, the income from gas in terms of revenue is about 20/80 And over the years, on the average, you can see how it's growing. For a lot of reasons, beyond the fact that this is a natural hedge for us, because of the volatility in crude oil prices, there's stability in gas prices, but these are used for the local market. Also, the fact that the gas prices locally are indexed in dollar but received in naira also help us to manage foreign currency risk on our balance sheet. So completely, it's about 80% of our revenue in foreign currency and just 20% in naira. And that has helped us to manage our balance sheet very, very tightly. Our targets have always been to manage our cash in a way that we always have cash on our balance sheet. In the past 4 years, we have a minimum of $200 million on our balance sheet. As at the end of June, result which are announced today, we have about $299 million on our balance sheet. And if you look at how the net debt has been trending downwards over the years as well. Our operation is very nimble, and that allows us flexibility in terms of CapEx spend. And when we face volatility in terms of crude prices and we don't have enough for CapEx, we're in a position to scale down our CapEx spend for each of the years. And that has helped us. I'm going to talk about the way we manage our cash generation, which sits on three legs: or revenue assurance, cost reduction, and flexible capital allocation. On revenue assurance, we focus on asset integrity and safety. And Roger talked a lot about the community relationship that we have. When you have FTO, freedom to operate, it doesn't come very casually, because the communities have to welcome you in their community, allow you to operate, safely, which is the challenges that probably the IoT have had over the years. But we, being a leading indigenous company, it's a major focus to make sure we're set up within the communities, because that assures our revenue to ensure we continue to operate in those areas. And of course, evacuation routes is very important to us as well, because those pipelines as well suffer a lot of loss on those pipelines. But with the relationship with the communities, and those pipelines are sustained to continue to evacuate our products. We talked about 80% of our revenue coming from crude, and that's coming from in foreign currency, and that also helps us to ensure that we'll continue to have good the resources to fund our operations. In terms of cost reduction, we're a low-cost provider. Today, we're looking at about OPEX of about $9 per barrel. Our break-even is about $15.5, and that allows us to continue to operate at even a very low oil prices. In terms of flexible capital allocation, I talked a bit about that in terms of we being in a position to adjust our CapEx depending on what kind of cash flow that we're seeing as a company. On capital allocation, our priorities is to continue to focus on low-risk opportunities to generate very good revenue for the business. We talk about the gas investment we're making, and also in terms of gas processing. Roger talked about the urban investment made over the years, the anode that is going to come on stream, and the Seplat gas plant that we also invested in, and which is going to come in by first quarter 2023. I think Effie will talk more about that. We'll continue to drill more and more gas wells, to feed the demand that we have for gas in the country, and focus on developing low-risk fields, particularly for maturing assets that we have on our western asset. In terms of return to investors, we have been paying dividend, like we talked about the quantum of dividend we paid over the year, but also consistent in making a dividend payment. Currently, we just moved to a quarterly dividend payment policy. So we intend to continue to maintain dividend payouts. And when we then have stable flow, particularly from the gas business, we may consider having a progressive dividend policy. We have significant retained earnings, about $1.1 billion as at end of June, to continue to fund dividend payment irrespective of the fluctuation to have in business, particularly being an oil and gas company and the kind of fluctuation from time to time. Our balance sheet is very, very, very strong. I won't talk about the results for this year, for this half year. I'll speak more as to where we are currently. But largely leveraged within acceptable limits, We have a leverage of, in terms of net debt to EBITDA, under 2%. As a matter of fact, about 1.7 at the end of June. This past half year, we refinanced our bond that we issued previously at about 9.2 for refined at 7.75, about $650 million of a bond that we issued at the end of first quarter this year. And we use that to repay our RCF completely. On our inland assets, we also funded inland by restructuring, by refinancing their RBL, and also getting a secondary traders facility to support the operations of inland. Currently, we enjoy very high credibility, with our financing partners. I believe that over the years, with the quality of governance management and capacity in terms of operation of the business, we've kept our promises in terms of making sure we meet our obligations, financial obligations, and that has, over the years, given us the credibility to continue to raise capital that we need from time to time. We are looking at opportunities, but value creating M&As in our space. The IOCs are migrating out of onshore shallow water into deep waters, and that creates opportunity for acquisition. We'll look at those opportunities as they unfold, but we'll be guided by our interest in gas and transition energy, and continue to buy assets that will give us more gas to dominate the gas space. We intend over the years to continue. You will see from yesterday's presentation, to extend our investment along the gas value chain to be able to take advantage of the opportunities that we have in that space. I would say we have significant financial firepower today to drive our operations and to take advantage of opportunistic M&As that may come to play. Today, we have $299 million cash on our balance sheet. Our RCF of about $350 million are not drawn at all. And so we have about $650 million of liquidity available to us. And our bond is trading very well. We're going to tap into the bond. And we also have our on the RCF in case we need to get money very, very quickly from the market. I talked about our credibility and our track record as a company in terms of financing partners. Since the IPO, we brought about $2.4 billion, and we paid out $1.7 billion, about 69% of what we borrowed over this period. I talked about our net debt position. This morning, we released our results for half year June 2021. We'll continue to show very strong performance. Our production was within guidance at about 50,000 barrels per day of oil equivalent. And on the back of that, and the current upswing in the price of crude, our revenue went up this half year by 32%. I talked about our cost of production at 9.7, a net debt of 556 million. The operating profit at about 100 million, and our pre-tax profit was $62 million, and our PBT was about $6 million for this quarter. The business is running well this year, and we believe that will meet our expectation in terms of the guidance. And if you will talk more about that, and we believe that the price of crude will be sustained largely for this period. Thank you. I think we'll take a break at this time. I'll hand you over to Carl. Thank you.
Thank you. We are actually quite a way ahead of time. Do you want to take a break, or should we just carry on? Or we'd scheduled a 10-minute break in, but if I think it's worth having a break. Okay, so let's take a break now until 4 o'clock. We're a little bit ahead of time, but it just gives you 10 minutes to have a glass of water or hopefully a cup of tea. So reconvene at 4 o'clock. Thank you. Okay. Okay. Thanks very much, everyone. Welcome back to the second half of the presentation. In this half, we'll be talking about the upstream business, the midstream gas business, and our plans for new energy, and then there's plenty of time for questions afterwards. So I will now hand over to Effiong to talk about the upstream business.
Let me just test this if it works. Okay. All right. Good afternoon, everyone. Again, I think it's nice seeing everyone. Since was it 2019? We had the last 2018, 2019. And like Roger mentioned, I hope you're all staying safe. So what I'm going to do in this session is to run through the upstream part of the story. Whether I would like it or not, the upstream has been really the core, the foundation on which the legacy has been established for Seplat. And the upstream is still going to be a material part of our future, in as much as, Roger talked about the opportunity, he talked about the potential in the country, and then also the very strong legacy we have been able to establish over the last, I think, 10 or 11 years now. And then America talked about lots of cash. We've given back a lot of cash to all our investors and all our stakeholders, but underpinning that very strong, extraordinary performance is the upstream business, right? So, but before I start, I want to say we're extremely, extremely grateful to all of you in this room, investors, communities. We always like to put on the major resource holder first, the government of Nigeria. It's always a privileged place to be when you have all these assets. It doesn't come easy. So the government remains a major resource holder, and we really want to say we're really delighted and really blessed by the rich portfolio we have. And we've also added value over the years. I'm sure we've earned the right to, based on our performance. And also, big thanks to all our communities giving us the right to operate. We just talked about the LTO, license to operate, freedom to operate. Without peace in the communities, there's no way we can operate these assets. It's a very, very challenging part of the portfolio. And also to our very strong, wonderful board, management team, and the bigger Seplat organization. So I just want to open with that really deep sense of appreciation. Thank you. So what I'll do, I'll talk about 4 or 5 key items around the upstream part. But the goal for us in upstream, these days we don't want the oil to be in the ground. If you look at all the forecasts, there's a concern around. It's better to have that oil on surface today than in the ground. So on the upstream side, our goal really is to develop our upstream business really, really aggressively to accelerate monetization of the portfolio by selectively expanding our asset base, optimizing that balance between gas and oil. I already talked about gas remaining the transitioning fuel, and also driving production, optimizing costs, driving down costs through very strong operational excellence, and also doing this in a very responsible way, cleaner way, reducing our carbon intensity. We all know the whole story these days around decarbonization, and driving our revenue up as well, and also, giving the market that assurance. We have done it, and I strongly believe looking forward, the legacy we've established is propelling us into the future, and also diversifying route to the market, which has been one of the biggest operational challenge we've faced as a company with all the issues around the export route. But I'll show what we're doing about that major risk. So Niger Delta is, one of the most prolific delta basin in the world. I worked in the US, in Europe, in the Middle East. You look at a few big basins like this: Brunei, Niger Delta, part of New Orleans. It's also a deltaic setting. The Nigerian portfolio ranks really top quartile in terms of very, very high quality reservoir rock, light oil, very high permeability. And that's why people say below ground Nigeria is blessed, massive opportunity, and we know all the above ground issues. So on that basis, Seplat has got a really robust portfolio. If you go through the slides, key assets, we started from the western asset, which is basically OML 43841 in the west 10, 11 years ago, and then we moved onto the eastern asset. That's where we're building the ANO plant. Yesterday we'll talk about the ANO project, which brings the material gas to the market, makes us the leading domestic gas player in the country. We also come with condensate as well, very rich gas. And then from 2015, 2016, our latest baby, Ubima Elcrest, which is the southern part of that picture you're seeing, very close, and sorry, the north, pardon my geography, northwest part of the picture, and that's where you have Betiokun Ubima, the acquisition we made in 2019. So it's a very rich portfolio in terms, it's quite diverse. People think our portfolio is single Niger Delta, not really. You've got a mix of oil and gas, we've got multiple fields, different production facilities, and also multiple export routes across the portfolio. So the first big one is our production to Forcados Terminal, which is where we started in 2010 post acquisition from Shell. That terminal is operated by Shell. And then we also walked an alternative route to the Warri Refinery, which was very helpful during the 2016-17 sabotage on the Shell export route pipeline. And we're working on the AEP, the Amukpe-Escravos pipeline. I will talk a bit about it. I know there's quite a lot of questions around that project, but that's one main part of how we then diversify export of crude production from the western asset. That line should be on production before the end of this quarter. We're looking at September, but I'll talk a bit more about it much later. And then OML 40, we're also looking at, before that, we're also working on getting the potential option to build an export route that goes offshore, shallow water to an FSO. I will talk about that in my subsequent slide. And finally, OML 40 comes through from Betiokun Opoma production coming through the Trans-Escravos pipeline to the Forcados terminal. So that's basically what the portfolio looks like, very rich. And then if you look at the left-hand side of the slide, that shows our 5-year outlay in terms of a capital investment program, where we'll be drilling lots of wells going forward. As part of that, accelerating the development and the depletion of this reservoir so we can monetize these assets as quick as possible. And then in that 5-year plan, we're looking at primary number of wells split per asset. So the western asset takes the bulk of that portfolio, and then we'll then move on to the OML 40, Ubima, Opama and Betiokun, where we'll also do a lot of new well drilling. And Roger talked about Sibiri. I'll come back to that later. If Sibiri is successful, it's a near field exploration opportunity. If it's successful, all we do is just hook it up to the existing flow station at Opama. So it's not, we don't have to waste time to build new facilities, a straight hookup, and you start monetizing that production within the first 1 to 2 years. Then next is OML 53, Ohaji South, and also GCK, where we'll also do some new wells drilling, and also the Ano wells are also part of that block, and then Obi Mount 283. So in summary, today we're at roughly around 33,000 barrels of oil out of our oil portfolio. In the next 5 years, we will drill those wells to address decline in production, at the same time bring incremental growth above the current plateau production, which is saying. And that's underpinned by the very rich reserves portfolio of just under 241 million barrels. Okay, so that's a bit about the oil story. I'll flip on now to the gas. So gas has also been a big part of our portfolio. So we sit on a very rich gas reserves base, roughly about 1.5 TCF of gas. In terms of, on the right-hand slide, in terms of that portfolio distribution, I think what that slide shows is the three main core centers for our gas processing. Started from Oben, somewhere, I wish I could use, I can't use the pointer here, but just at the center of the northern part of that slide, you see that circle, it covers Oben. Oben, we've got 5 new trains built by Seplat post acquisition from Shell, expanded. There were 2 old trains, and we built 5 new trains. And each train is about 75 million scf of gas per day. The Shell old trains are 45 million standard cubic feet of gas per day. So collectively, 5 times 75 plus 45 times 2 is what we have in Oben now. So we can bring in gas from anywhere, processed in Oben. The next one is Sapele. We're upgrading the Sapele gas plant from to 85 million scf of gas per day. That project is on stream, hopefully sometime around early 2023 is what we're looking at. Then on the lower part is Ano. Usually we'll cover Ano. Ano is a pretty much unitized asset with Shell and ourselves, and the NGC is also in that mix under the AGP CSPV. And that asset should come on production next year. So in total then, if you look at our gas business, I think was also earlier mentioned by Emeka as well, we're moving towards roughly almost 800 million scf of processing capacity next year, gross. And that takes us closer to ambition to be a 1 BCF of gas processing capacity company per day. So overall, I think the other strategic part of this, the gas reserve, is actually around major demand centers, which means that with those major demand centers, you can easily hook up any other gas field to those process trains which we've built already in Oben, and then the new ones coming on Sapele and also Ano next year. So OML 53 really is one of the largest greenfield gas and condensate development in Niger Delta, and I'm sure we talked a lot about that during our last Capital Market Day, the investment we're making there, and how this will be part of powering Nigeria's economic transformation going forward as far as gas is concerned. So that's the gas story. So we're proud to be, part of that past and also the future as we go through the energy transition. In terms of investment, I think Emeka talked nicely around how we've been able, the flexibility we'll have to basically scale back, scale down, and scale up. So last year, if you all recall, we had planned to spend quite a massive capex, program until COVID struck sometime in March, and we had to scale down in terms of capital investment. And then looking forward now, we have built a very strong program for this year based on that, factoring the potential oil price scenario in this year. And then on the 5-year business plan, we're looking at somewhere just under $1 billion to $1.2 billion going forward, covering wells to bring in new production, also facilities. So we are building, apart from Ano, you all know about, and Sapele gas plant, we're also building a new liquid process facility in Amupe, so we can process water in situ and then inject water, and that way we don't have to spend all the money in focados to process water. We're trying to get to a world where we take care of our water in situ dehydration and only dry crude get to the terminal. That has a massive saving for us from an OPEX point of view. So part of what you see in terms of our forecast in the next 5 years is to build that liquid treatment facility in Amukpe. Sapele also will put a brand new compression station for gas lifting to support the Sapele development, and also a new water treatment facility as well. And finally, our decarbonization program is also heavily underpinned by part of the CapEx investment we're looking at, and I will talk a bit about that shortly. So overall, a very robust 5-year outlook to drive a lot of the financial aspiration and ambition we have as a company. So solid portfolio, solid investments, and so then move on to, so if you look at then, that's all around discovered portfolio, which is, my earlier point around, we want to drive accelerating, monetizing these assets with a very disciplined approach, underpinned by, clear strategy around capital allocation to gas, to oil, and the mix. And then we'll keep driving operational excellence. Our ambition is to become top quartile in all areas of operational excellence. That will then put us, world class, whether you're looking at how we operate the asset, how we deliver new projects, and also how we drill new wells. We're doing lots of benchmarking. We've had actually a lot of Rushmore benchmark, also McKinsey benchmark. We know clearly where we stand today as an organization in terms of those key operational matrices. And we've got a very clear roadmap on how to close that gap to potential. In some areas, we're actually top quartile, but the areas where we're not top quartile, and it's about how we close that gap to potential. For the new projects, we're also maturing new 2C contingent resources to 2P, which is part of, today we sit on almost 500 million barrels of oil equivalent, 2P and 2C. So part of that investment will move the 2C to 2P in that bucket. Then you go to the next bucket, 600 million barrels of oil. That covers 2C and 2P. Yes, the 500 is just the 2P. So that differential, part of that investment is actually mature a lot of the 2C to 2P. Then we have a big exploration portfolio. It's actually, people talk about Nigeria's, Roger showed a slide of 37 million barrels of oil and 200 TCF of gas, right? But the undiscovered portfolio in Nigeria is actually more than a discovered portfolio, which people don't really talk a lot about. And we do have a share of that undiscovered portfolio. And what that shows is, if you look at all our assets, from the western asset to the eastern asset to Elan, there is a material prospectivity portfolio we have in there for leads and prospects. So we will be doing quite a number of exploration drilling going forward, and we'll start by end of this year with the Sibiri exploration well. That's to test that prospect on the rightmost part of the table, which is about 74 million barrels, and then risk to about 30. That's a major material play for us in the history of Seplat. But it just shows you also on the western asset and the eastern asset, we do have material prospects. And the beauty is, if these prospects are successful, we don't have to invest a lot on CapEx. You just hook them up to Oben or Amukpe or, over where we have all our processing. So this is a very, very attractive, very rich near-field exploration potential, which would see us begin to put a lot of money now to open up that space, open up the play, look at the deeper play as well in that process. So huge, huge, huge opportunity. And we'll go at a pace in which so that we can still get all the cash out on time. So I want to talk about the export route. I did mention it earlier on. This has been one of the biggest challenges we've faced historically over the years. But at the same time, if you look at the history of the company in the past 10 years, we have been able to work up options. And I'll start with the Western asset, which is where I'll say 70-80% of our cash still comes out of the Western asset. Historically, we've always exported through the Shell terminal for Cardos, through that TFP line. TFP line, we've talked about a lot about the uptime of that line, the integrity of the line. It's been faced with lots of sabotage, lots of challenges. And that's how we went into the AEPP project. So AEPP project, the line has been laid, just to give everyone that assurance. That line was fully laid, hydro-tested, dewatered, and in 2019. And then what was remaining was just the scope around the Chevron terminal. And then COVID struck early last year, and then Chevron, of course, every company hunkered down, stopped a lot of project activities. So APP was also impacted by COVID-19. But the good news, we've been back to the Chevron terminal. We went back there in Q1. We started doing the remaining scope. So all the scope within the Chevron terminal, IPC pipe rack, large unit installation, fire and gas system, a lot of the mechanical work is pretty much done. We're going to integration now and working all that interface with Chevron. And our plan is by in September, we will introduce hydrocarbon into that line. So our first offtake will then happen sometime in Q4. So I'll say good news, and we will pop champagne this year, inshallah. On the Warri refinery, that's something we also did put out as a potential option if we have a major outage on the export route. I talked about the Escrovos terminal, and then on the Brass terminal also for the eastern asset, GCK flows through Brass, and also the OPL28, that's the Newton Pillar asset investment well. And that's actually quite a reliable line. If you look at uptime and losses, quite low. And then Bonny terminal as well will flow Ohaji South to, and also the OML 55 crude, that's Belema. And then there's a whole lot of refinery coming up now in the country. In the east, we do have the Waltersmith refinery, which sits just next to Ohaji South, and we will put some crude through that refinery as part of our diversification strategy. And also OPAC is also building a refinery, which is also very close to OPL 283. That's the Newton Pillar asset. So in summary, you can see how we're working de-risking the export route. We continue to look at options, working this collaboratively with other operators, other opportunities, a lot looking out for synergies as well, as against just embarking on this ourselves. So, and that way we can drive uptime across our assets. So that's the Amok West Travels pipeline, which I talked about. Just talk a bit more around what's happening on this space. So if you look at Focados, a TFP line has suffered downtime of roughly about 18% in 2021. And historically, it's always been somewhere between 20-25%. And I think last year it went down with a lot of improvement around the security surveillance. The line is not operated by Seplat. It's operated by a company called Heritage Oil and Gas. And then you also have losses on that line because of the sabotage. Now, the beauty about AEPP is that it's buried to about 15 meters depth, so it's very hard to access the pipeline. The very rare pipelines installed in Nigeria at 15 meters depth. So this is going to be one of the very few new ways with HDD technology to bury the pipeline, so it's then difficult to sabotage or access. And that's what we're very confident around when that line comes on stream. We should be looking at the uptime for the Western asset in the 90% neighborhood, as against 80% or 70% we saw on the TFP. So the other good thing about the AEPP is that it gives us access to the Chevron terminal and also to the NPSC terminal, which is just next to the Chevron terminal. At the same time, we're going to tee off before the Extravos terminal to go to Otumara and then to Focados. So that gives us almost like, three potential options around the APP, building a lot more flexibility and robustness around how we drive that top quartile availability for the asset. Our assets normally run at about 95% availability, 5% schedule downtime on then or schedule. The problem has always been with the third party interference. That's where we see that 21%. Otherwise, we run those assets at really top quartile benchmark above 90% if you take out all the export route issues. So hopefully, with that cluster, with Betio-Kun Opama, with the new line that's going to be laid connecting Betio-Kun through the Adakwasa pipeline to the TEP, coming into Escrovos and then to Focados, we have a very robust set of export route now to support that whole OML 40, OML 4, 30, 38, and then 41. And hopefully when we report our end of year performance, we'll see how this whole project will have transformed uptime factor for the Western asset. So it's a big one for us. I know it's always one of the areas we get lots of questions on. We're almost there, almost there. And then move on to the next part of our operational excellence. So driving production up and then reducing cost, which is quite key to be competitive. In the Western asset, I talk about what we're doing around taking our water in situ. In the past, we sent about 30,000 barrels of water to Focados. You can then do how much that then cost us, $30-40 million per annum. With the progress we've made around the liquid treatment facility, that saving has been banked now because that system is now working and we're taking our water in situ and injecting that water. We also have a new project that will even further enhance the performance of the LTF. And we also do a lot of reliability work, bringing in new pumps, life extension. You have to realize that these assets are quite old. Some of these assets are 40, 50, 60 years old from Shell. So a lot of what we've done since we acquired the asset is to put in a lot of money, life extension on the asset integrity assessment, and getting those assets back so they can still run for another foreseeable future. So that's with the Western asset. Then on the Eastern asset, we kicked off production in Ohajisa with a leased facility, 15,000 barrels of oil per day. And we're also doing some appraisal around Owu. The whole idea is we would like going forward to install a new CPF, which will process about double the capacity we have now. As part of that, monetizing that asset base I shared earlier on, and hopefully bring that in production in the next couple of years. And then on the GCK, which is a very old asset just next to Adax, we are doing a lot of debottlenecking, installing compression to help with the vertical lift performance because the wells are also quite old. And Eland, new acquisition, we're doing actually this year 3 wells, very big wells, 3,500 barrels per day. And we're taking 3 fresh wells come on production between August and December. At the back end of that campaign, we'll then do the Sibiri well. The Dabgasa pipeline will help us take out the cost around the barging cost for now, which we do barging from Betokun to the BRVS manifold. That's going to be another major cost reduction activity around the Eland asset. And same with water as well, trying to drive down. So hopefully, if you put all that together, forward-looking as part of that 5-year plan, we will be taking down costs significantly, unit operating costs from the asset. I think we sometimes get a bit conservative, like we don't talk a lot about some of the good stuff like Rogers talked about during the community, but there's a whole lot we're doing in the asset as well, just to give you that assurance that we're not just driving investment production, but we're looking at how we can be very competitive. I always say that our common enemy are the Arabs and the Russians. Maybe if we can get our production costs down to under $4-5 per barrel. So in terms of technology, I think was also earlier mentioned, yes, we've been slow with technology deployment, but we're doing a lot now. We actually put a process in place. There's a clear framework around technology screening, whether it's in the R&D space or it's off the shelf. And we have deployed quite a lot of technology in the past couple of years. We have, for example, now operators don't have to go to the wellhead on their screen. They can look at well performance and intervene in terms of surveillance. And then we've actually modeled our asset so we'll get better predictive capability around the future performance of the asset. We can monitor and predict the performance of every oil and gas molecule from reservoir to export. And that's what the Seplat virtual asset management technology is all about. On the right-hand side, you see a whole range of technology. I'm not going to go through all of that, whether it's about remote surveillance. We're doing big data analytics, predictive analytics, where you can look at compressors, temperature, vibration, and pressure data, and be able to predict when you have a failure, so you can intervene before the compressor fails, and that way you don't have downtime from the machine. That way we're pushing all those equipment towards top quartile performance. So top quartile is somewhere between 90-95%. So running. So that drives production automation, Internet of Things, artificial intelligence, integration, a whole suite of new technology. And the beauty about companies like ourselves, we don't have to invest in a big research R&D organization, because all these vendors are just after us like bees. They come in, offer us. We had a very successful technology week a few months back where a lot of vendors came in to showcase their technology. And for us, it was like going to a restaurant, look at the menu list and pick what you like to eat. And that for us gives us a lot of flexibility. So to look outwards a lot more against being inward looking or insular. So that's one we will drive, and we'll be talking to the market time to time about how we're making huge progress on the technology space. So the other one is about decarbonization. Flares, I think the flaring accounts for over 90% of our carbon footprint today. We've done a very, very good baseline, scanning all the assets using the latest technology, IR, infrared, and we know where all those emissions are from the assets. It's very, very clear, and also in addition to the flares. So scope 1, scope 2, very much mapped out, and we have a very clear roadmap of how we're going to end flares or end of routine flaring. Let me qualify that, because you really can't be zero flares. If you have an process offset, you still have to blow down your facility and then burn some gas. But our target is by 2024, we will end routine flaring. And that gives us a lot of that advantage in the sense that we then monetize that flared gas which are flaring today. It's good for the environment, and also we then become responsible operator, and pretty much lies with this whole desire by the world for low carbon world. So that's the first part. In terms of projects, these projects are all being studied, well scoped, in execution. So OBEN we will take out the flares down, convert that to LPG, which fits nicely with what Roger talked about. LPG then goes into the local economy to replace some of those biomass you talked about. And then driving uptime of our existing compressors, and also installing new compressors for the low gas pressure system. And then the Seplat gas plant then will be one of the last big projects, and the OBEN LPG in 2023, and hopefully all that will then take out all that flares and drive down costs for us, because for now you do pay penalty for gas flaring. I think that's the story around any routine flares. And once we're done with flares, then we'll now tackle the remaining 5-10% of our GHG by looking at our equipment, how we're changing some of the, I think that's what this one talks about. If you look at our field operations today, we're driven by electricity, gas, or diesel. So there's some machines or pumps that are driven by diesel, some are driven by electricity, and some are driven by gas. So a lot actually driven by gas. So you still have some components that are driven by diesel. For example, when you have a plant trip, you need to go through a process you call a black start, an emergency start, and that's where diesel tends to come in. So what we're working on now is how do we replace that diesel with LPG and even LNG or CNG, and that way we don't need to have diesel gen as backup. And that helps us with driving down the whole carbon footprint. So we're very clear in terms of the roadmap, and then we're looking at how we can also bring in, solar and other means, other more environment-friendly energy sources to support those equipment. Overall, that's the plan in terms of how we want to drive emissions apart from the flaring discussion. Asset integrity. I did mention that these assets are quite old, but we have worked a lot around bringing these assets almost, I would say, new state. So 2010 to 2018, we've had a roadmap in terms of the awareness status. And then we've actually been, the regulators have actually given us a lot of support. 2019, we're driving a lot of improvement across meeting minimum standards. 2021, we see that results playing out in terms of uptime and a lot of investment still going into how we drive down our maintenance, life extension on quite a number of the portfolio. And then our ambition is by 2023, we will be ISO 55001 certified, which is real, one of the top standards when it comes to asset integrity in the industry. So overall, this is going to have a big impact on operational excellence, driving down our performance to top quartile, increase asset lifespan, and then reduce deferment, and then also reliability across the portfolio. This is something that's very close to, right from Roger to myself, one I keep my eye on almost on a daily basis, and we have a weekly cadence just tracking performance, and the team has been very, very extremely, very, very engaged and very excited about how we can give these assets really long life. I think that's it from me. So in summary, I hope I've been able to paint a very convincing story around how we've established our legacy with the upstream business, very strong historical performance, and that's going to be, upstream is going to be key to driving the future, and all the initiatives around driving down, monetizing those assets, accelerating, giving back cash to investors, decarbonizing our portfolio, and then improving project delivery, well delivery, and operational excellence. Thank you very much. Hand over to you today. You are the future.
Okay, so how do I use this? So thank you, Effie. And good afternoon, ladies and gentlemen. Of course, you all know that without the upstream, there cannot be a midstream. So that's why I'm saying thank you to Effie. I'll be taking you through the midstream gas business, as well as the new energy pillar. And I'll start briefly with the midstream. So the goal of our midstream business really is to develop the huge gas resources that the country has. And it is mainly to accelerate the replacement of diesel and biofuels and support economic growth through the supply of reliable and low-cost energy. Our midstream model really is to supply gas to power on base load to electrify the country and to support renewables. So that's basically the goal of the midstream gas business. If I take you to the next slide. Like Roger said, Emeka says, and Effie also mentioned, Nigeria has a very large gas reserves base, about 200 TCF. And it's about 37% of the total gas reserves that we have in Africa. But there's a challenge. There's a challenge with gas utilization, and that's basically because there is infrastructure under development. And that has really impacted the access to electricity. So if you look at the chart, I hope this works. Okay. If you look at the chart on the left, you will see that out of the total gas that is produced, gas export, gas reinjection, and fled gas make up almost 80% of what comes out. So which means that we are not really utilizing the gas that gets produced. In fact, the amount of gas we flare is almost equal to the gas that we use to produce electricity. So that has always been the basis. I mean, if you think about the fled gas commercialization program that the federal government has embarked on, it's mainly to harness the fled gas and convert it into power, convert it into usable income. So that has always been one of the key objectives of the midstream gas. So we have looked for options of capturing the gas, the fled gas, and converting that into usable economy. If you also look at the National Gas Policy of 2017 and the declaration of gas as a decade of gas by the government as well, you will see that everything is going towards the path of gas. Gas is pretty much the transition fuel for the future. Woodmark, in the study that they carried for us, have said that gas to power market will grow from 5 gigawatts, from the current capacity of 5 gigawatts, to almost triple, that's 13.6 gigawatts, by 2040. Okay. if we look at the, okay. Seplat is doing an excellent job in the gas domestic market. And we'll be doing more in building market strength. We're looking to utilize the Oben gas processing plant as a hub, and mainly to keep the capacity full so that we can increase the ability to use it as a processing hub. So what we've done is to address or try and gather and mop up all the gas assets that we have within the Oben area so that we can keep the gas capacity full. We are also, together with ANO, the ANO comes on stream in the first quarter of 2022. It will increase our processing capacity to 765 million scf of gas per day. We also have the OB3, which is still in the pipeline, and it will allow us expand gas supply to Abuja and beyond when it's completed later this year. Effie talked about the 75 million scf Sapele gas plant project. That's expected to come on stream in 2023. So if you look at all the pipeline, the gas processing projects we have in the pipeline, we are getting close to our 1 BCF processing capacity processing, which has always been the target at which we communicated to all our investors. Gas provides a natural hedge against oil price volatility, and you will see that for the past 5 years or thereabout, our average gas price has been relatively flat, even in areas or periods where we've had very low oil price, like we experienced in 2016 and in 2020. We see that hasn't affected our gas price. Gas returns very good and very steady earnings, basically due to the lower taxes and the lower royalties on the gas, and also the fact that there is less disruption to the gas pipelines. In terms of revenue, you will see that we've had an increase in our gas revenue year on year, except for 2020, where we were really affected by the COVID pandemic. Our 2021 outlook is likely going to put us back on the path of increase based on our first half performance. Okay, so I'll talk about ANO. ANO is really a flagship project for both Seplat and for the government. It's a critical gas project which was initiated for the actualization of the gas master plan, and it's on its way to be delivered by next year. So since FID was taken in Q1 2019, we've been able to get full funding for the project. In terms of the physical project, the manufacturing of the plant and the balance of plants have been completed, and the shipping is underway. We're expecting that by the end of this month, most of the shipped equipment, especially the rotating equipment and the process equipment, will be delivered in country. The upstream wells are currently also being drilled by Shell, who is the upstream operator of the plant. So still on ANO, The annual model is one that provides income to Seplat from two sources. First, on the upstream side, through the sale of wet gas from the NNPC and Seplat JV, which is operated by Shell, like I said, and through a unitized operating agreement. With a 50-50 sharing formula between the Seplat JV and the Shell JV. The second stream of income comes from the plant itself, the midstream plant itself, and again is a split of 50-50% between an SPV, more or less, between Seplat and the Nigerian Gas Company. And the products from the processing, in this case, the dry gas, the condensate, and the LPG, are shared in the same formula, 50-50, and they are returned to the shareholders in the form of dividends. So there are two sources, really, for the actualization of that. So with the decade of gas, mantra by the federal government, we see scalable opportunities in the domestic market. For Seplat, we will continue to supply gas to the domestic market and capitalize on infrastructure capacity growth and secure additional markets in gas to power, both on-grid and off-grid, and to supply gas to industries, to processing of NGLs, and additional off-takers in the gas value chain, particularly in the LPG and in the CNG space. So there's very strong government and external support for this, especially the CNG. And then with the expansion of OB3 and the AKK, new demand centers are likely to open up. So there's opportunity for Seplat to partner with industrial customers, and we will be strategic partners, really, of choice as a result of our track record in the gas space. Okay, so I talked a bit about new markets in the gas value chain, where we see potential and where we can play. So the gas to power is one, and we see the opportunity in the captive power sector, where we can partner with others and supply power to industrial parks, and also to hospitals and very large residential estates. Manufacturing, and so on and so forth. Woodmark predicts that the captive market will grow from the current low base of about 0.2 gigawatts to 4 gigawatts by 2040. And possible entry strategies for us will be, building or acquiring pipeline assets, or getting or acquiring power plants. The CNG market, is an emerging opportunity, and we are considering in particular for automotive purposes. On the gas product side, we'll focus on LPG markets as the replacement fuel for biomass. The penetration of LPG currently is low. It's about 13%. And the aspiration of the government is that it will grow to 7 million tons per annum. And so that's an area that we see opportunity in the value chain, and we intend to take advantage of that. So our domestic gas supply is predominantly to power, and from our analysis, the upstream indicatively on a net back basis, gets about 3 cents from the cost of grid electricity to the final consumer. So what that means in essence is that Seplat as a gas supplier to the on-grid market only has access to 3 cents, which is about 20% of the entire gas value chain of on-grid electricity, which is priced at 15 cents. And of course, with off-grid gas to power, the potential is even much higher. So Seplat can actually, capture additional value along that value chain. If you look at diesel, which is estimated about 52 cents per kilowatt hour, there is a much bigger potential to displace that with gas. So that huge potential to Seplat to gain more in the gas to power value chain. If that is displaced, then that's a big value that Seplat is trying to go into. So I'll go into the new energy. And that's our third pillar. And our third pillar, really, which is in renewable energies, is to achieve world-class capability in renewable through the development or acquisition of new skills that open up new and profitable markets. So solar, according to the study done by Woodmac, will dominate the Nigeria energy outlook by 2040. And so there's opportunity for Seplat to create an off-grid solar power distribution business and to supply the commercial and industrial sector through displacing diesel generation. Solar house systems is another area of prospect, for the solar sector. In comparison to other countries in sub-Saharan Africa, Nigeria really ranks highest because it has the best regulation in support of mini-grid solar. That's according to Woodmac's study. So, and that's because we see support from the World Bank, we see support from the government, and even the African Development Bank are all in support of this solar initiative. For Seplat moving into this area, though, it will require a new set of skills, either acquired or developed. But it's an area that we want to explore, and we'll get there. So the off-grid market in Nigeria is projected to be worth $17 billion by 2040 per annum. And this is based on, back of the envelope calculation between demand and the expected gas price. It's expected to grow to 20 gigawatts by 2040. And for the indicative power price, solar is cheaper. It's cheaper, much cheaper than the power generated from diesel. It's almost half that amount. So, given the declining cost of solar electricity, we see a situation where it will be easy for end users to move to solar because it's more affordable, and it will also help to displace diesel. The country, if you look to the right of that slide, shows that there is some PV potential in the north. That's the red zone. And of course, we don't have pipeline access in the north at all, except for the new AKK that is just being developed. And so to electrify the north with solar is an opportunity that we see. And it's an area where already we've seen the markets being developed. We've seen companies, renewable energy companies, siting mini grids in the north and expanding it to the rural areas. So it's an area that we will look at. For now, we have looked at where our areas of interest are, and we will develop that as time goes on. So I think that gives a bit of context to where Seplat is going in terms of the midstream gas and the renewables. And I think, Roger, we come to finish it up.
Okay, everyone. So it's we've bombarded you with slides, and I think you've managed to sit through all that. So hopefully it's been quite a lot of help. I just want to wrap up, and then what we'll then do is we'll get into some Q&A from the room, and then also we've got Q&A online as well. So just concluding today, I think we've heard today that Nigeria has an incredibly fast-growing population that is starved of infrastructure. It needs energy to develop and deliver on its social agenda. So social and economic development is critical. We can't have the scenario where 200 people become 450 million, third biggest country in the world, that has this access to energy. And really what we're seeing ourselves is really part of that drive to actually get the energy in country right for the Nigerian population. So it's really about energy access drive. We've got to do this. We've got to get the cost of energy down. And, it's very expensive. And you heard today some of the numbers, and I'll run through those again very quickly. We've got 20 gigawatts of energy today. So the majority of energy today is diesel-generated energy at 52 cents a kilowatt hour. That annually we estimate is a $80 billion cost, and it's imported. Every single litre of that diesel is imported into Nigeria. So $80 billion of foreign exchange reserves are going out to import this diesel, and the Nigerian population is spending 52 cents a kilowatt hour. There is a huge drive to actually displace that diesel, which has a greenhouse gas emission capability, create more wealth in the country, and actually, more importantly, spur the social and economic development. If you look on grid, 15 cents a kilowatt hour from Yutundi's slide. Seplat plays in 3 cents, so 20% of that is where Seplat's playing today by selling its gas bulk. And what the message we're really giving here is we want to move down that value chain. We want to capture more of that, whether it be of the 15 cents a kilowatt hour on grid, or even more interesting, I think, for us is the off grid, 29 cents a kilowatt hour. So we've got 10% of that. And what the commercial drive is, the alternative is 52 cents a kilowatt hour. So I think there's a huge opportunity for us to do that. So that's why we want to move down that value chain. In doing so, there is an environmental impact benefit of doing that. And we can drive improvement, and we can report transparently of our business. So we're being very clear what we want to do. We want to look at other forms of gas value. We are currently not monetizing on LPG, so we're just selling that dry gas, and then the C3, C4s, which will go into bottled gas, will then also go into households and commercial uses, which will then displace firewood. Also CNG, and the government's driving very hard for autogas, and that's a big market for us, and therefore compressors onto our gas plants to look at that. And as we follow that molecule down the value chain, we see opportunities in gas to power. And just to be clear around that, that is not looking to do highly regulated, big ticket power plants, 500 megawatt plus. And it's not the market we're looking at. We're looking more in the smaller scale, say up to 100 megawatts or maybe up to 200 megawatt gas to fire power plays, because it's a natural home for our gas. Okay, and it's really following that gas value chain down and capturing more of it. And obviously, as the base load going into renewable energy, having solar and gas plays together is a natural bridge, electricity bridge into a renewable future for the business. So it's all thought through in terms of the connectivity, which is really delivering that transition that we want to do within Nigeria. And it will drive down costs, it will save CO2 emissions. And it will be the right transition agenda for this country, which then hits the social at the same time as the environmental. As investors, don't panic, because obviously our big focus is on dividend payouts. It's return. We're seeing some recovery in the oil in share price, back up. We just in around the £1 a share. We believe there's more value than the capital growth of that, but irrespective of all of that, what the dividends give shareholders is an annual, actually quarterly, is a regular return. And you heard today that we've returned over $400 million since IPO. And we'll continue to do that in terms of our policy. And as Emeka pointed out, what we'd like to do is progressively grow that dividend, but we want to do it in the back of a progressive growth in the revenue stream and the profitability of the business, and capturing more of the value chain will then enable that or facilitate a lot of that. In terms of investment, our investment CapEx is really targeted around maintenance CapEx. It's keeping our production the levels they are, but it's also growth CapEx. So we're really looking to see where we're drilling a number of wells this year. The most activity is OML 40, which is the Eland acquisition. We're drilling 3 Betty Oaken wells. And as Effie pointed out, they're prolific. They're 3,500 barrels a day each well, dual string completion. So what that really do is those 3 wells should add around, in gross terms, around 10,000 a day production. And we have almost 5 of that. And then obviously we have exploration at Sabiri, and that then we'll find out into probably Q1 next year when we get the results of that. Our program next year will be similar to the programs we set this year. So if you look over the next 5 years, you're looking in that 1 billion to 1.2 or 0.9 to 1.2 billion of capex in around that program. But our cash generation's ahead of that. And you can see that when you look at our numbers. In the first 6 months of this year, we have $125 million of operating cash flow. We have very strong EBITDA of almost $180 million of EBITDA for the 6 months. So this is a cash machine, this business. It's able to completely fund its capex program, pay its debt, return its dividends, and have additional cash for inorganic opportunities and growth. And that's our model, really, is to do that. So then leads into the acquire significant and attractive divested assets. This is not M&A for the sake of M&A. What we saw years and years ago when we came to we were one of the pioneers of it as a company, we saw the changing of ownership of assets in Nigeria from IOC, International Oil Company hands, into indigenous hands. And that's really what Seplat started off as. I think in the last 11 years, it's been slower than we thought it was going to be, although there has been a lot of divestments. But I think over the coming years, by the sort of nature of where the international oil companies are really focusing on the offshore plays, higher technology plays, is you're going to see ownership in Nigeria transfer into indigenous hands. And Seplat's well positioned. It has an ability then to look at each asset individually or corporate activity individually. It can then assess it. And what we're really saying to you is, look, we're looking at assets that we can create value in, oil and gas, and actually plugged into our future business. So I think we're well positioned. I think there will be attractive assets coming to the market, and Seplat is very well placed to capitalise on that. In terms of expanding new gas markets and infrastructure, again, that's an add-on to our business. We will do that naturally in the gas business, but we're looking at widening opportunities, and we have the market there to do it. And the last one is, we've talked a lot about it, but power generation. This is not, Seplat jettisoning from being a upstream oil and gas company to leaving all that oil and gas in the ground and becoming a power utility. It's not at all, but it's a natural transition for our business to capture that value chain. So that's what we are really saying today. It's the first step in the communication. We'll obviously continue the communication. We have a summit in October. We have branding exercises beyond that. And so it's sort of watch this space, but we thought we'd just lay it out to you in this Capital Markets Day. So certainly from my perspective, thank you very much for listening. Carl, do you want to come up and explain the rest? Thanks.
Thanks very much, Roger. I hope everyone found that interesting and informative. We'll now start Q&A, and what we'll do is we'll start with questions from the room before handing over to the operator that's managing the online and phone participation. Being COVID safe, we don't have roving mics, but the building is actually quite wired, so it will pick up your question without a microphone. But if you could just stand up and let us know who you are and ask your question, and we should be able to deal with it. Once we've done with the questions in the room, we'll hand it over to the operator. So who would like to start? Gentleman there.
Hello, I hope you can hear me. I'm Nick Norbrook from the Africa Report. I had two quick questions. First, on the transition. At what year do you expect your gas revenues, total gas revenues, to outstrip your crude oil revenues? And second, just to understand the history, how is it that Seplat avoided the fate of the handful of other indigenous oil companies in Nigeria who bought at the top of the market from departing IOCs and who have struggled really since then? Thanks.
So first question was the time of transition to revenues from gas. It's kind of an interesting one. Who would like to take that one?
Do we want to? So we'll just do, okay.
Yeah,
why don't I kick off with this? So and then we'll interject. So, I mean, it's a question we've asked a lot. How does gas mix work with revenues and oil mix? And today, it's generally around 70-30 or thereabouts, between in favour of oil, obviously. The answer is that we don't foresee anytime soon the reversing of the mix, and the reason being is because the oil is a very critical piece of the jigsaw puzzle. Oil is much beyond just exporting it out of country. Our oil business is a very big employer in the region, in the areas, and everything else. And we have a lot of oil reserves. So we don't see anytime soon that we would just leave that oil in the ground and go into a gas business. What we're looking to do is it's the mix. Okay, so I don't see it anytime soon being anywhere near, and we're not forecasting it'll ever reverse around that. What we're forecasting is, yes, we could probably see 60-40, maybe 50-50. Certainly we've done scenario analysis around that, so much more of an even balance as we play through it. But we certainly don't see it reverting the other way. So hopefully that answers that one. And then in terms of the previous divestments, I mean, we don't speak ill of others. But what to say from our perspective, when we look at divestments, we have a pretty thorough process, and what does that mean? It's not just analysing the reserves and doing the NPV analysis and come up with a valuation. We look very clearly at the development programme that we could put into the asset, because that's critical. It's not about just buying the asset; it's what you can do with the asset when you've bought it. And so we spend a lot of time challenging ourselves how many rigs we could put on it, what type of activity we want. Normally it's short-term oil gain activities, infill drilling, etc. So we have a very detailed plan, and to date we've been able to deliver on those plans. So we're quite conservative in doing that, so that make sure that the asset ramps up, it creates enough cash flow to pay off that debt you borrow on the acquisition. So that's one part of it. I think the control and the understanding of the relationship with government is another one. So we spend a lot of time with our government partners, working as a true partnership, ensuring that they're on board with what we're planning. We've built, I think, a capability of that in the last 10 or 11 years, where there's a high degree of confidence from our government partner to support us. With our operator in developing the assets. I think the combination of all of that, particularly the development plan going forward, I think is why we've been successful. And look, I think certainly the quality of these assets that were previously invested, the quality's not changed. So there is a lot of potential for these assets, and I think over time that will get rectified, and these assets will continue to produce into the future.
Okay, next question. Yeah.
Alex Smith from Investec. Thank you very much for your presentation today. Just a quick one more on capital allocation. So over the next 5 years, you kind of mentioned that CapEx would be about $1 billion on the investment program, and actually 75% of that is into the oil business. So where will the investment program go into the new energy business and into the new infrastructure? Maybe what are the size of the opportunities there? Because you mentioned 100 to 200 megawatt power plant, and how much will that cost? And how does that compare to the oil business investment program? And then second of all, just on returns, comparing the returns of the new energy business compared to the conventional upstream business, and are you confident that it will compete in terms of capital, in terms of the IRR of drilling an upstream well in oil and gas, as opposed to a solar farm or a LPG kind of project? Thank you.
Why don't I go with the first one, and whatever I don't cover, maybe you can cover, and then why don't I give the second point to Effie, which is really about the upstream. Okay, so in terms of balance the capital allocation, obviously what we're signaling today is, look, we're looking at that gas to power market and solar market going in the future. It doesn't mean that we're saying today we have active, investment, approved investment plans. What they've done is the board has supported us going this direction. And of course, any activity you'll have will be then subject to a separate board decision around that. But what we're looking at is, it's that value chain. So it's that 30 cents a kilowatt hour, if you're looking at off-grid, which we're capturing 10% of it today. So what we're looking to do is, how do we sensibly capture that call it molecule through to electron and going into the market? To answer your direct question, what would a cost of a 100 megawatt to 200 megawatt power plant? That should be $100 to $200 million type of investment. Yes, there will be other investments beyond that, potentially in transmission, but what we're really looking at is more of the captive market rather than the on-grid market. I think it's a better business model for us. And it gives us then an ability to trace that gas molecule right through to the end consumer, targeting, creditworthy entities in doing that. So that's how we're thinking about it. So we've not built it into that $1 billion over $200 million per annum. But I think at these sort of levels, if you do the sort of back of the paper analysis, if you're looking at that level of power price, which is huge. I mean, it's you wouldn't see that in many places in the world. I think you can then justify it. and doing that. So it's a signalling today. It's not actually saying that we're building it into our CapEx programs. Yeah. Is there anything I didn't?
You covered most, but I'll just take on the renewable side. The fact of the matter is that not just in Nigeria, but most environments, the capacity of the renewable sector to attract capital to absorb capital today is limited. And also in Nigeria, where it's just an evolving segment. Our promise, there's already be a reality check in terms of how we are going to evaluate these projects. At the same time, in the level of expectation in terms of return, because the right check that will continue to maximize returns to our stakeholders, including our shareholders. We're not going to undertake, it's not going to be a greenwash. It has to be clearly something that makes sense for us to do.
Effie, do you want to deal with the upstream?
On the 75%. Okay. Sorry. Can you hear me? Okay. So Alex, I think you're right. If you look at the slide I showed, it's about, we'll spend 76% on oil and 24% on gas. I think the way to look at this is our investment in gas is becoming more of a cash engine for us. If you look at once ANO is done next year, we have built the plants already. Oben is existing, so there's not a lot more capex going to Oben. And then Sapele gas plant, like we did mention, we delivered early 2023. We'll have spent almost all the capex left on Sapele gas plant next year, which adds 85 million cubic feet of gas processing capacity. So by end of next year, basically, gas becomes more really big cash engine for us. We don't have to do much other than drill infill wells in Oben to utilize the oilage available in Oben. And that's why you see the capex for gas then pretty much pulls back. Whereas on the oil side, we keep drilling, going for new wells around all the assets, whether it's Gwechiokun, already talked about, or Poma, or whether it's Mukwe or Ovo, and also even in Ohaji South in the east. And also, so that's why you then see not just drilling new wells, we're also building a new process train in the east, for example, around the Ohaji South asset, and also the liquid treatment facility I talked about in Mukwe, where we're upgrading so that we can process all water in situ, and also even in Sapele, where we build a brand new facility for water. So in summary, the 75% capex you see going into the oil investment is really, really unlocking, trying to accelerate monetizing the oil portfolio as much as we can. So oil would attract a lot more investment compared to gas going forward, but also the returns on these oil projects are quite very, very attractive. I mean, we go through every single investment on a project basis or well by well basis to see that really it does scale all the rate in terms of IRR or return on average capital employed or return on investment. So it's quite robust return. So look at investment, but I'll also say maybe, although we haven't showed the sort of returns here today, but they're very, very, very attractive opportunities. Thanks.
Yeah, I mean, we can give you a bit more on that. I mean, if you look at, I mean, we'll take a good example of the Elcrest wells. You know, so they're flowing 3,500 each a day. You know, you're drilling 3 wells, you're putting 10,000 on. You know, if you ran that for the full year, you get 3 million barrels or a bit more than that. If you're drilling those wells at 20 million a well for the swamp, you know, you're $60 million investment, you're getting 100. Pick your oil price, but if you take $50 oil net back after royalty, it's bringing $150 million of revenues for that level of investment. Now, they are particularly good wells. Not every well in our portfolio is the same, but that's the way we look on it. We look at what's near term, what we can drill, hook up, and produce, but also we want to produce our portfolio. So it's a bit of a balance, but I think certainly what we've shown through, when you see, you know, different oil prices across our portfolio, we've always been able to generate cash. What's really held us back, I think, more than anything else, is downtime. So it's downtime and losses, shut-ins. That's why we're really pushing hard for the alternative exports. You know, that we probably lose 30%, and if you're looking on 12 million barrels a year, you know, it's a material loss of oil that we have. By getting alternative exports in there and ensuring that you don't have that downtime, that's a very efficient way to really just hit the bottom line.
I think you touched on that there's
returns from the oil and gas business. So can the new energy compete with that level of return that you're seeing in the upstream business?
I think over time it certainly will be much more competitive than it is. I think that's globally the case, but it's sort of an unfair question, because the reality of life is the world is going through transition. There is a much more of a drive from all the countries, and Nigeria has signed up to the Paris Agreement, so there is a commitment there to reduce CO2 emissions. So I think when that world's been made that decision, of course, if you look on like-for-like analysis of the technology, we haven't invested that much as a world in renewable energy, but it's coming down every year in terms of cost. Its efficiency's getting better, and so I think over time that will be a very different answer. But of course today it's, particularly at $75 oil or whatever it is, that oil business is very profitable. But the key thing is we want to extract the oil, we want to monetize that oil, and then we want to be very selective in capital allocation of how we reinvest those dollars.
The next question from Nick.
Hi guys, it's Nick Stefan from RenCap. I've got three to ask, if I may. So just want to go back to Alex's question on the new energy business. So is this more of an aspirational kind of like target, or do you have something a bit more concrete in the pipeline in the next 5 years? Because you didn't give CapEx guidance or any kind of like specific project you had in mind, so that's why I'm asking this question. And then on the economics, a lot of other oil companies, what they do is they kind of like set up a business, they put some equity, there is debt on that JV, we're not gonna call it very, very low cost of debt. Have you assessed the debt market for renewables there in Nigeria? And is there, what kind of like interest rates are we talking about? Because the financial engineering part would definitely, improve economics quite a bit. And then finally, on the production, if you give some production numbers, it's more like a recovery. I think on a gross basis over the next 5 years for both oil and gas. I tried to do some math there. It looks like you're averaging something like 35,000 barrels per day for oil. And probably I got my gas numbers wrong because it's a very, very high number. But can you give me an idea of where we're seeing group production in 2 or 3 years? Because it looks like it could double. Is that the case?
I'll come back to your question. Any more?
No.
Okay, Effie, why don't you start with the last question first?
Okay.
And
Let
then
me.
Maggie, you can-
Carl, can you go to the slide with the production historical so that I put a bit of context to address the Nick Stefan's question? The one around the 10-year.
It's the same on this one.
But are the colors friendly at all? They're not, these don't look environment friendly. The green one that Roger used. The one Roger used, yeah. Yeah. Yeah, this one, thanks. So, Stefan, what's happened historically? Do I have to? Can I go on the screen?
Yeah.
So if you look at production historically, this is oil. This year we give guidance of 48 to 55,000 barrels oil equivalent per day, split between 30 oil and 21 gas. We'll end up the year around, hopefully the high end of the guidance. But what's going to happen now is, so the oil production you see here, just like we earlier talked about. So we've got new oil coming out of Sibiri, Bachio 3 wells, almost 10,000 gross by end year. And then next year, we haven't published our plan for next year yet, but we're going to be we'll be building a very robust drilling campaign on the oil side, which then takes production up. ANOH comes on stream, we do talk about it. Almost 20,000 barrels of condensate gross. You can take half of that. So that additional condensate comes in there. So from a liquid point of view, clearly we are headed in that direction. We're always careful about numbers. Rogers, we've got to be very careful. But clearly, with the investment profile, I talked about that 5 years drilling campaign over 50, 60 wells. We will clearly grow production to address decline, at the same time add new production on that level, in addition to the condensate. For gas as well, it's logic. I mean, it's just simple logic. ANOH doubles our gas production because ANOH's capacity is pretty much almost same as what we're doing today in Oben, right? 250 million scoff of gas per day. You take the working interest there. So you have a doubling effect. And ANOH is meant to be on plateau for at least the next 7 to 10 years. It's very rich. It's about 40 CF of gas in that block that straddles Shell and our block as well. And then you got condensate. So it's massive growth in our production. You know, we always be careful around what we say, but clearly we're growing production is what I'll say. When we talk about, we'll build a program for next year, and then we'll go to about October again. And then when we talk about it in Q1 next year, you then see our forecast going forward. So in summary, I may not be very number specific, but clearly we're growing the liquid side from the new wells and the condensate coming out of gas, and also we're growing gas, almost doubling our gas profile with ANOH coming on production next year. So we're on the right path, right trajectory. And that's going to underpin when I talked about cash engine to deliver all those maximizing shareholder return Emeka talked about. It's underpinned by that outlook, very, very robust. I'm really excited about it. Does that help?
Somewhat.
Okay.
Do you want to answer the other?
Okay, yeah, I can take that. The renewables in Nigeria have been led by solar, solar services, and rapidly expanding. Okay, rapidly expanding, particularly because of the gap you have in terms of electricity availability in the country. For most of the household, after transiting to solar, there are at least 3 companies that are leading, that are winning currently in the country and rapidly. We have information about how much they raised in one of the reports that was done, but probably it's in the region of $200 to $300 million in the past 3 years. At least I know a company that had done at least $100 million last year.
Is that debt?
Is that what?
Debt.
No, they did equity. Yeah. About equity. As a matter of fact, the local private equity firms are probably in about two of those companies already. That shows you, the kind of projection that they have based on which P's are putting money in the business. To be honest, I give you information later. I give you 3 companies and I give you information about how much they raised in the past. It's quite an interesting proposition in the country currently. And I can tell you, okay, for instance, one of the companies have taken over almost about half of the bank branches in Nigeria. That give them a shot at how much they pay for power, and they take over their genset and are putting solar. Of course, not because they can't have solar all through. So the combination of their current gensets and solar, and they give them a mid-range of prices to pay. It's rapidly expanding. But I give you the information outside. If I want to leave, I get information. I give particular companies and how much they raised in the past 2-3 years. Yeah. For us, there's no allocation to solar currently. But like you said, we are transitioning from upstream to midstream, and now we're making heavy investment in gas. And currently, the top pillar being renewables. We are studying the market because also you need to know what kind of play you need to undertake, because really it moved from actual manufacturing to distribution and all that. So we are studying that market to know exactly how we're going to play in that market. And that's what you need to refer to. There are no capital allocation to that currently, I must tell you.
Cover off the question about new energy being an aspiration or a specific. Nick's first question was new energy. Is this aspirational or specific? Are we working on specific projects at the moment?
Let me answer that one. I mean, I think to touch on it. Like first thing, we've got the board supportive of what we're doing. Okay, and it's a clear message from the board. Now it will be a process to go through and identify. We've seen projects in the past. I think for us, it's the balance between what we don't want to do is go after projects that are, there are enough 5 to 10 year projects around in renewable energy. I've seen ones into 20 years. So, that's not the model we want to play in. Whatever we're looking at, we want to deliver. Okay, and over, say, a 3 to up to 5 year period. You really want to be on stream. Now, the board set us some targets around really looking at bringing it for a project to an FID at the board earlier, within the next, I think by the end of next year is set. They want it sooner than that, but the reality that is why we say, look, we are really, our target would be in the smaller scale, so up to up to say 200 megawatts, thereabouts. It's not particularly small, but it is small in terms of the need. When you get very big, the history has always shown that you're into quite a long development cycle. If you look at Azura, who we supply a lot of gas to, third of our gas to, I think they were 8 years end to end from start of development of a project to building the plant. And that's not really a game that we necessarily want to play in. So it's not aspirational at all. Is it project specific? Somewhere in between the two, because we haven't got specific projects which we are coming to FID now, but we will have pretty soon. So we're certainly moving that direction. What Yutundi talked about is bringing the skill sets in. This is, you're moving into utility skill set from an upstream skill set, and therefore we bring that into the company, but we're actively doing that now.
Okay, any other questions from the room? Sorry, yes, sir.
Hi, Werner Riding, Peel Hunt. Question on the Sibiri prospect. So, by memory, in the slide pack, you had 74 million barrels of unrisked resources and 30 on a risk basis. So, 40% risking on that prospect. So, I'm just trying to get my head around why so low, given it's 5 kilometers away from Mopuama. It's on the other side of a fault. There's a clear structural trap. Reservoir risk is practically zero. There is oil there. Why only 40% when it's basically everything else is pretty much 100%?
Explanation. All right. Any other one? That's it. Okay. So exploration stuff is always like art. It's not like I always admire my finance colleagues. Always very specific on a EBITDA and NPV. And so you're right that Sibiri itself, we don't have a play map. All the discoveries, this massive discoveries around Sibiri, there's only one failure in that block. Every other well was successful. So there's very good charge, source rock, good fault trapping mechanism, and good migration path, and also structural closure. So we looked at and had a lot of debate back and forth. Historically, we've done only one exploration well, I think, in Seplat in the west, and was a bit of a mixed bag. So going into this prospect, we then said, okay, you know what? Let's take a bit of a more conservative approach and put that risk at about 40 or 30 you saw. At the same time, we also talk about 74. It's actually the high end is almost 130 million barrels, quite large. So looking at the P10, the P50, P90 scenario is actually quite range. But like exploration, there's always that caveat around, look, you can have one singular case where there could be a failure, or it could be a trap failure, it could be a chart failure. So very, very careful. So you're indeed spot on that. If I put on my former world where I worked on before, this will have probably been ranked with a much higher possibility of success than what we're carrying today. But we're just being careful. We're not really a big exploration company. If you look at our history, we've done a lot of brownfield assets over time from the West and East. We're just going now into exploration, so we want to go in there cautiously. If Sibiri proves to be 700 million barrels, post-discovery, we'll then begin to recalibrate all our prospectivity play, and then look at, that might also open a new play for us completely. So I'll say we're just being cautious. You are spot on that it could potentially be, even in a risk case, double the amount of resource base we're carrying now. So spot on. Thanks. But the good thing about Sibiri is it's not just whether it's 30 or 70, it's also very close to Puama. And you can bring this on stream. I mean, those days, I remember my Shell days, you make a discovery, it takes you, like 4 or 5 years to do all kind of study work, appraisal. But this one, within 1 year, appraise the structure, get DPR approval, we could be on production sometime late 2022, early 2023. So we really want to aggressively monetize that, whether it's a 30, 70, 150 million barrels scenario. Thanks.
Thanks. Any more questions from the floor? No? Okay, so I'll throw it open to the operator now, if the operator can hear me. We'll take questions from the online presentation and the phone lines.
Okay, ladies and gentlemen, we will now take questions from the conference line and written questions from the webcast page. As a reminder, to submit a written question, please use the Ask a Question button. We will begin with the conference line. If you wish to ask a question, please press star 1 on your device. If you then decide to withdraw your question, simply press star 2. Thank you very much. Okay, so the first question is coming from the line of Michael Osford from Citigroup. Please go ahead. Your line is now open.
Good afternoon, all. I'm sorry I'm coming in person, but I've got a couple of questions, if you could answer. The first one would be on ANO. I was particularly pleased to see the confirmation around the timing of first gas. I'm just wondering, obviously it remains still a challenging operational environment with COVID restrictions, etc. Could you perhaps talk a little bit more about what remains on the critical path? I guess what you worry about, I guess, in order to deliver on that target. And the second one was just on the Westport loan. If I remember correctly, you were due to start receiving repayments on that loan from 2022, and they could be quite material, if I remember rightly. So I was just wondering whether that's still the case, and or maybe you could just update more broadly on that financing. Thank you.
Okay, thanks, Michael. I actually going to hand this across. The first one to Effie, and then second one to Mecca.
Okay. So on the first, hello. Okay. So on ANO, in terms of project execution, I think it's gone extremely well. All the rotating equipment has been manufactured in Florence, Italy, by Baker Hughes already, shipped, actually on transit. The process vessels by GP in Dubai, all done, ready. In fact, we'll start taking delivery of those vessels, and those are the two big part. Now, in terms of the foundation on site, foundation is gone as per plan, very much on track. So the target is all the equipment will be in country. Q3, we'll start installation. We're heading towards mechanical completion by end of the year, Q4. So what's then remaining really is to then start commissioning and they're ready for startup. So we have Shell has drilled, currently drilling 2 wells out of the 4 wells planned for this year. That also means that by end of the year, there will be gas wells ready on the upstream side from SPDC to supply gas into the plant. Now, COVID, we've been able to manage COVID, and we took a somehow kind of haircut in terms of our schedule from last year. I think if you look at guidance before was to come on stream production this year. So we have rebaselined the project delivery schedule, and that's why you then see, they talked about on stream now happening next year. I'll say end of first half of next year is what we're looking at. So all that put together, I think in terms of critical path, the real 2 things we spend a lot of time on is the OB3 pipeline and also the spur line that connects the ANO plant into the OB3. Those projects are being executed by NGC. So they're not our project, but NGC is also part of the AGC board. I'm on the board, Roger's on the board. We get constant update from the NGC team. They're really looking at all. There's been some delays with completion of those 2 projects, the spur line and OB3, but the latest estimate is it should be ready sometime in Q1 next year, late this year, early next year. And that's what actually part of why we also have moved first gas to somehow around middle of next year. So in summary then, I'll say all the scope we're executing, not on critical path, is the one being done by NGC, who's also co-venturers in the AGPC deal, driving the OB3 and the spur line. That's what we see as what's on the critical path now. And that's a determinant for mid-year first gas next year. But we're very optimistic with the progress made so far. Mike, I hope that addresses your what's on the critical part for ANO.
It does, thank you. That was really helpful.
Okay.
Okay, on the Westport loan, we're on track to meet all repayments on that loan. The Aircrest asset is doing very, very well. And the economics has slightly improved with the new oil prices. They're drilling 2 wells like we just talked about this year on that asset. So we're on track there There are no concerns whatsoever, no warnings of any issues around the operations and the facility.
I think just want to add to it, Michael, I think if you're looking at the old schedule, obviously there's a shift in the repayment of that loan. But I think, in fairness, in 2020, the asset was clearly affected by the the impact of the oil price. We had to cut down or shut down capex on it. Really, this year is the year we're putting those wells in, and then you're going to start to then see an accelerated pay down of that loan. So on the schedule that we bought it at, it's changed, but we're pretty confident. Well, in fact, we're very confident that this loan will pay down. It will be probably 1 or 2 years later than we originally forecast.
Okay, that's great. Thanks, Joel.
Any further questions from the operator, from the phone lines?
Yes, we do. So the next question is a written question coming from Charlie Sharp from Canaccord, and it is a two-part question. So the first question is, an important part of the first part of the presentation focused on ESG, and in particular, societal responsibility and commitment. The education and healthcare contribution to communities has been $5.6 million, which translates to around 0.1% effective tax rate on $6.2 billion revenue share. As a right to operate, do you have plans to increase that to a more material level? And for the second part of the question, what level of overall asset uptime and losses do you anticipate following commissioning of the AEP? Will you include a LACT unit on that export route? Thank you.
Okay, I'll answer both those then. So the answer is yes, we are looking at our community investment program in some detail, and look, I think just you need to take the absolute number itself rather than the percentage of overall revenue streams. It's quite a material investment. It's not the only investment we make in the regions. And obviously we have added additional assets on it over the years. So the short answer is yes, we are looking at it. What level we're going to put into it? It's about not just making an investment, but or a donation. It's about what you can then generate as a sort of magnifier effect from that. But I'll just leave it. Yes, we are absolutely looking at that level. We haven't settled the level yet. In terms of your question on AEP, look, we're looking to get that up and running this quarter, and then having our first liftings next quarter. So you don't know until you start operating, but however, we do expect the losses to be materially less around that. I mean, I think we budget a couple of % of losses on it. And then downtime, currently I think the Transfer Cadis pipeline is anywhere sort of 15 to 20% downtime. Other pipelines are higher than that. We would expect the EP to be 10 or less percent downtime on that. But again, until you get it operational, you don't quite know. We'll be us and I think Pan Ocean be the only two injectors into that, and so therefore we have a lot more control of that. We have a LACT unit absolutely in both ends, one at the injection end, the one at the terminal. And so therefore that reliability of that meter should mean that we should have quite material reduction in losses from our Western assets.
Okay, any other questions, written questions from the operator?
Yes, we do. So the next question, again, is a written question coming from Uwa Osadeaye from FBN Quest. And the question is, are there gas export plans to replace/complement oil effects earnings in the future? Thank you.
Okay, why do I answer that one? Actually, do you want to answer it? Okay, I'll answer it then. Just on export plans. So the answer is, look, we were looking at, obviously our gas can go into a regional place. So, it has a spec to go into the West African gas pipeline. We have had quite a number of discussions of the countries that pipeline feeds, Togo, Benin, and some early stage discussions with Ghana. So in a regionally West Africa, there's definitely a market opportunity there, and we're trying to advance that for offtakes. The other one is just it's a discussion item at the board. It's not relevant, I guess, at the minute because of the nature of where our gas is. But obviously LNG could be a area that we can look at in the future, subject to and that will rather be on acquisitions that would then be able to feed LNG trains. Just where we're located is not relevant today, but we see over time building out a West African model and LNG is a natural progression for our gas business.
Okay, any further questions? Seems we have another one.
Yes, we do. So the next question is coming from Khalil Wali from Cardinal Stone Research. And the question is, on expanding the gas business down the value chain, will Seplat be adopting a gas power plant model or reaping the benefits of additional value added through partnerships with power plants? And when is the estimated timeline for the commencement of the new energy solar business? Thank you.
Okay, Yutundi will answer that.
So with the expansion of the gas into power, we are looking at partnership, either with an industrial park where we can latch on to the captive market. We are also going to be looking into acquisitions. We had said that whichever is easier and whichever one brings value to the company was going to be the option we will take.
And solar timing?
Well, at least for solar, the decision that we will go into it has been made. So it's no longer an aspirational idea. Right now, we want to go into a study, still with Woodmark, where we kind of zero in on whether it's off-grid solar or on-grid solar. That will take another 6 to 1 year for the study to be completed, after which we will go into the development stage. So in another year's time, we will be able to give you a firmer answer as to when the project is going to start.
And we'll challenge you on that one, Yutundi, on your timeline. I think, look, it's all about opportunity sets. In reality, solar in Nigeria is nascent. There are some projects that people are trying to develop. It's very early stage. So it all really depends on the availability of the opportunity set. For us, we don't see ourselves playing in ultra low scale, low size solar like panels on roofs. I mean, that's not really where we would play. But, sort of mini solar grids and everything else is absolutely something we would look at. But it's all to do with the opportunity set. And that's really what Yutundi, I think, is highlighting, is a cautiousness to go into it to make sure that we can scale up whatever business that we decide to go into. Thanks.
There's a couple more questions, yeah.
Yes, so the next question is coming from Brad Verbitsky from Equinox. So the question is, what is Nigeria doing to fix its power grid? Is there a risk it doesn't get fixed and you have no demand for your gas? Is there anything you are doing to assist them? Thank you very much.
Who wants that one? No, I think Yutundi, do you want to?
That's a very difficult question to ask because the study we carried out with Woodmark specifically downplayed, the growth of the on-grid market, and mainly because historically, they haven't seen that rapid growth in the on-grid gas to power market. But having said that, I mean, the government has tried through so many programs to incentivize the gas to power sector. One area we know clearly is the cost reflective tariff, which just recently got launched last year. And what that has done is that it has stimulated the market a bit and allowed all the issues with legacy payment of gas payments to actually be addressed. The Siemens, partnership with the government is another area where they're trying to expand the transmission system, which has always been one of the big bottlenecks in the gas to power market. So it's little steps in the right direction, if I must say that, but we would not see that big, that quantum change in the gas to on-grid market. In fact, instead, you will see that the off-grid market is where the growth is actually being proposed from.
Yeah, I think just to add to it, it's where the desire is. Clearly, there's a commercial market behind this. There's a commercial reason to do it because the alternative is so much more expensive. What it really needs is companies like ours and others to work with government, who I know want to fix this issue. I think there's now a drive within government to do that fixing of the issue. Technically, it's not. There's not barriers on a technical standpoint. It's the interaction between the players in the market, between the discos, the bulk buyer of power, MBET, and also the gas generators, some of which actually don't even have gas supply, but which are on grid and built, but don't have gas supply. So it requires all the players to put together. I think certainly our WoodMac study that we had done, their view was that those barriers would be too great to fix. We don't necessarily agree with that. I mean, I think the barriers are that they could be fixed, and it's about working together with government to fix it, because we really need a functioning on-grid market within Nigeria. But time will tell. There's debate around the table here of when, if that's possible, and when that could be possible. And we have different views around it. But it's certainly technically doable, and it requires just us working with government and other players to deliver it.
I think I was going to add, Roger, I think today there was an announcement that the subsidy on power, it's going to be gone by January next year. And that's also one of the challenge around the power sector. Once the subsidy is gone and that end-to-end value chain, it's actually very attractive commercially, and then you then see investors coming in. I mean, I'm a Nigerian, to be honest. I don't have any other country. I'm a bit more optimistic with what the government is doing. It's just like what gas was. I mean, when I was those days, gas was like 10 cents per MMBTU. Today we're selling gas at, $2.5, $3 per MMBTU. So, and that's why you see the strategy is actually to position ourselves, and we're cautiously optimistic. But clearly, I strongly believe that this is going to open up big time in the future. I know that a lot of people don't believe it, but I strongly believe in it. That's my personal view.
And maybe just to answer your specific question, are we concerned around our existing gas business? And the answer is no, we're not. We're contracted, long-term contracts around that. We have high confidence around that market continue long term for us. So it's not an impact on our existing business. It's just how we expand that business is where the consideration is.
Okay, thanks. I think we have one final question, one or two questions just from the phone lines or from the web.
Yes, we have. So the next question is coming from Nick Linnane from Seplat Place. The question is, what do you see as the main impacts on your OPEX? Royalty rate, and tax rate if President Buhari gives assent to the PIB in its current form and you convert all your licenses? And can you stay in the old system for some licenses but convert other licenses? Or do you need to make one decision for all licenses at the group level? Thank you.
I'll take it. Okay, thanks, Roger. So I think the PIB in terms of royalty and tax is actually very good. It's very attractive. If you look at oil now is 85 ppt. If you then go to the what's in the PIB, again, depends on what, I don't know what version of PIB you got hold of. But what we think is the official PIB actually looks at, much lower. And it's going to attract a lot of investors into the oil space, recognize energy transition and all the concern. So in the new PIB, what we see is reduced. I know there's hydrocarbon tax, HCT. There's almost like multiple tax regime, but grossly still less than what we had under the PPT. Royalty also, which was a big issue around this inshore deepwater basin dichotomy, is also lower in the new PIB. So overall, I'll say from a royalty tax rate, it's actually very, very good incentive from government, in my view. I don't know anybody other views.
You also have an option for an election. So we're modeling which the different versions are coming at each time they call our model. That's why we can't be specific at this stage, but we'll wait and see. But we're hopeful that the bill will be signed before December. Hopeful, but let's see. Those hopes have been there over the years.
Your question is, do you have to go into, revert it immediately? The answer is no, you don't. You can sit in your existing licenses until the expire of those licenses. So I think our first license is 2027, so there's no immediate rush to do this, and you don't have to do it by the corporate level. You can do it by individual. So, there's plenty of time to look on it. It looks like it's certainly a very strong step by government. It looks certainly the viewpoint, there's a high degree of confidence that it will be passed. I think there are certain benefits to it, but we don't have to make the decision immediately.
Okay, and there's one last question from the web.
Yes, so the next question is a three-part question, and it's coming from Janet Okunkova from Telemer Capital. The first question is, with IOCs like Shell indicating plans to exit Nigeria, particularly onshore assets, would Seplat be interested in taking up these assets? Why or why not? The second question, on Nigeria, are you positive Nigeria can recover production even with the increased OPEC quota, considering Nigeria is producing even less than the allocated quota at the moment? And the final question, how soon should we expect Seplat to get knee-deep in the renewable energy, such as the solar capex in the north? Thank you.
Okay. Well, I was going to give Effie the second question, but he's stepped out. So, the short answer to your first question is, if Shell was exiting the onshore assets, would that be of interest? The answer is yes. Second question, in terms of the OPEC quota, heading up. Look, we've had certainly in our allocations and our assets, we have no issues now on that. So there's plenty of headroom. And will Nigeria be able to come back up? I think that's probably a question for someone else. Just in terms of the overall country, everyone's got different views on that. And in terms of then how soon will we go into solar, I'll say utilities change their view there. So anyway, look, I think if anything, the timeline would be opportunity set, but also, look at the mix of the revenue stream of the business. Solar is not going to make up a huge amount of the revenue mix in the short term, right? So I think, we just take our time to get into it properly, but we want to be able to scale that business, and that's really what we're looking at. It's not just a one-off project to sort of make a statement in the annual report that we can do solar. The reality is we want to build a business out of it.
Okay, I think we are done with questions, so we'll wrap up there. Thank you very much to everybody for coming out, taking the time to come and hear the Seplat Energy story. We do appreciate it under the current conditions. Can I extend our thanks to the speakers today, to Roger, to Emeka, to Effiong, and to Yetunde. I would add that there are refreshments outside. We have, I think, about 40% of the board here, and I think half of the executive leadership team, so please feel free to mingle and ask questions. Thank you very much indeed. Thanks very much. We'll close it there. Thank you.